Thank you for joining today's webcast. Your moderator for today is Mr. Alex Postma. Mr. Postma, you may begin.
Thank you. Welcome to this EY Thought Center webcast on the final reports in the base erosion and profit shifting project that were released last week by the OECD. Thanks for joining us. It's a pleasure to have you with us. My name is Alex Postma. I will be your moderator. Today's webcast is the first of a series of 8 webcasts in which we review the final reports issued by the OECD on October 5th in respect of the BEPS project. In this webcast, we will lay the groundwork for the next 7 webcasts that will delve further into the details of the reports on the various BEPS actions and their implications for global business. In this webcast, we want to provide you with a general overview of the final BEPS reports, highlights important changes vis-a-vis the OECD's earlier reports, and discuss the likely outlook and the timing of the implementation of the recommended measures by countries around the world. And with me to take you through this discussion are some outstanding EY professionals with a diverse and significant experience for our discussion. Let me introduce the panelists. With me is Barbara Angus. Barbara is our Strategic International Tax Policy Leader, very heavily involved in the BEPS project, previously held the top international tax position at the United States Treasury Department, and was a vice chair of the OECD Committee on Fiscal Affairs. And also with us is Ronald van der Brekel, who, prior to joining EY as one of our transfer pricing partners in the Netherlands, had 22 years of experience with the Dutch tax authorities and participated in the OECD working party that is responsible for transfer pricing guidelines. And I also would like to welcome Andrew Choi, EY's ITS leader for Greater China, to help us put more of an Asia-Pac perspective on these proposals. Now, let me remind you that you have an opportunity to raise questions during the webcast, and we'll try to get to as many questions as we can during the time that we have today. So, Barbara, let me start with you. It seems that these reports can be divided into minimum standards, reinforced standards, recommended common approaches, best practices. Can you share some background on that?
Sure. Thanks, Alex. So when the OECD put out the reports on the 15 actions, they also issued an explanatory statement. And that statement reflects quite a useful categorization of the output on the various BEPS actions. So the first category is minimum standards that have been agreed by the countries that are participating in the BEPS project. So these are areas where lack of action by one country would have an impact on other countries. The idea of negative spillover effects. The OECD identified 4 of the action areas as having output that falls in this minimum standards category. The first is Action 5 on addressing harmful tax practices, both the new nexus requirements and substantial activity requirements, and also the framework for exchange of rulings. The second of the minimum standards is Action 6 on addressing treaty abuse through anti-treaty shopping provisions. Then Action 13 is considered to be agreed minimum standards. That's the part of Action 13 that relates to country-by-country reporting and the sharing of that information between tax authorities through their information exchange relationships. And then finally, Action 4 on improving the effectiveness of dispute resolution mechanisms is also a set of agreed minimum standards. So in these 4 areas, countries have committed to consistent implementation in the interests of ensuring a level playing field across countries. The next category that the OECD identified is revisions of existing standards. This really encompasses the OECD's most traditional tax work, the maintenance of the transfer pricing guidelines and the OECD Model Tax Convention. Both of these documents are being revised pretty significantly under several of the BEPS actions. So in the case of the transfer pricing guidelines, we've got actions 8 through 10, the substantive transfer pricing items about aligning income with value creation, and then Action 13, transfer pricing documentation and country-by-country reporting. All of that is reflected through revisions in the OECD's transfer pricing guidelines. And then in the case of the model treaty, the Action 2 on hybrids has a small element that involves treaty changes. Action 6 that we just mentioned on addressing treaty abuse, Action 7 on permanent establishment status, and Action 14 on dispute resolution, all are things that involve proposed revisions to the OECD model treaty. And both of these documents or guidelines, the transfer pricing guidelines and the OECD model treaty, are heavily relied on by countries around the world. The transfer pricing guidelines form a basis or soft law with respect to transfer pricing in many countries, and much of the global network of tax treaties is based on the OECD model or consistent with the OECD model. The remainder of the recommendations in the final reports are described by the OECD as common approaches or best practices. These are recommendations regarding the design of domestic law, and that's an area where the OECD hasn't played traditionally, at least not to this extent. So the explanatory statement describes that common approaches are areas where the countries have agreed general policy directions, and as they use agreed common approaches that are reflected in the output, they see it as likely that countries' domestic laws will converge over time. So a couple of the areas that are this form of common approach are Action 2 on hybrids and Action 4 on interest limitations. Then finally, the OECD categorizes the work on CFC rules under Action 3 and on mandatory disclosure of aggressive tax planning under Action 12 just a little bit differently. Here the OECD describes its recommendations as best practices, and it's clear they mean that there are ideas or practices for countries to consider if the country wants to take action in these particular areas. And so as we'll discuss a little bit later, the final reports in both of these areas strongly acknowledge that countries have different policy objectives and different needs that will affect the choices that they make.
Thank you, Barbara. So we have decided, however, not to follow this approach, but follow a slightly different approach. And we'll divide today's discussion into three other major blocks. Recommendations that are expected to have the most immediate effect, recommendations that are treaty-based, and recommendations that are domestic law-based. So let's get started with an area that has been the topic of much discussion. And again, Barbara, maybe you can take us through what the final report on Action 13, country-by-country reporting, will bring us.
Sure. Thanks, Alex. And actually, before we turn to these BEPS measures with the most immediate impact, there's one more aspect of the OECD's October 5th documents that we should touch on, really just to fully lay the groundwork for the rest of this discussion. And that's the description of what the OECD intends to do next. What's in store for the OECD in this post-BEPS world, and this was also addressed in the explanatory statement. So not surprisingly for the OECD, the answer to that question of what comes next is in several parts. So first, there are a few actions where the OECD intends to do additional follow-on work. This includes several transfer pricing projects and also work in a few other areas, some additional work on implementation with respect to hybrids under Action 2. There is some significant additional work described in the report on Action 4 on interest limitations, also significant work on additional work on treaty abuse under Action 6, and then also in an area that is close to transfer pricing, the OECD will do the additional work on Action 7 on permanent establishment related to the attribution of profits to the permanent establishments that are reflected in the work that's been done so far. So then second, the OECD will develop an approach for monitoring the implementation of the BEPS recommendations by countries. I think it's fair to say that the parameters of this monitoring mechanism really have not been fully set yet, and in fact, countries have some different views on what makes the most sense. So that's an area that the OECD is still developing. But it's clear that the OECD and the G20 are committed to there being a robust implementation mechanism or implementation monitoring mechanism. Then third, the OECD has been directed by the G20 to develop plans for a more inclusive BEPS process to involve more countries beyond the OECD and G20 member countries. So to expand the dialogue, I think in part to better protect the level playing field. The G20 wants this more inclusive framework to be delivered for the first set of the G20 meetings in 2016 under the incoming presidency of China. And then finally, in the explanatory statement that was issued with the reports, there's a statement that the G20 and OECD have agreed to continue to work on BEPS until 2020. So there's a lot of post-BEPS work that still relates to BEPS. This continuing focus by the OECD, particularly a focus on monitoring country implementation, I think is really important context as we look to whether, how, where, and when the various recommendations will be acted on by countries. And that'll be a big focus of the rest of our discussion here. The immediate actions, the actions with immediate potential for immediate impact, and I think the biggest headline here is, Alex, as you said, country by country reporting. First, it's important to note that the country by country, the final report on country by country reporting doesn't reflect any real changes from the prior guidance issued in this area. The first guidance, or the first guidance in final form that we saw was in September 2014, when the OECD issued the final template for C-by-C reporting, which sets forth the requirements for what will be reported and provides some definitions and instructions. So a handful of pages of explanation around the one-page template. And just to review some of the key points with respect to the template. The reporting group is determined based on financial statement consolidation, not on transfer pricing control concepts. And that was a shift during the consultation process from the original discussion draft to the September 2014 report. So it's the group that exists for financial statement consolidation purposes that is the focus for the country by country report. Information is to be reported on an aggregate country basis, not entity by entity. So several entities in one country get summed up for purposes of providing the country line. The template and its instructions make clear that the OECD intends that there be some flexibility provided with respect to how to source the data. Is that you can use consolidated financial statement packages, for example, or statutory accounts. There are several options to allow companies to use the source that works best for them. The template requires reporting of high-level metrics: revenue, income, cash taxes, accrued taxes, tangible assets, and employees. It is there also entity-level information on lines of business or principal business, and then country of organization if it's different than country of tax residence. And finally, the template includes a third page where a company can provide additional information that's relevant. So then with the template out there, the next thing the OECD did was to issue in February a short document that detailed the agreement among countries on several issues that are really important to businesses from a practical perspective, and that had level playing field implications for countries. So here we're starting to get into to clear minimum standards. That document first gave us the de minimis rule. So reporting is required for groups that have 750 million euro in revenue or more. Also gave us the timing, that the first year to be covered by the reporting will be 2016, with filing of the report in 2017. And then, importantly, the delivery mechanism for the report. A company will report to the parent jurisdiction tax authority, and the information will be shared with other countries under information exchange relationships. Then there's a secondary mechanism of direct reporting, which will operate only if there's a failure in this central reporting mechanism. Finally, in June, the OECD put out a third document that included model legislation and model information exchange agreements with respect to country-by-country reporting. And you might have thought that kind of document would be relevant really only at the government level, but there are some critically important guidance provided through definitions that are contained in the model legislation. So it's an important supplement to the guidance that's in the original template document. And so now with this final report put out last week, it is essentially an amalgamation of these three documents collected in one place. So no new news here, other than maybe an important underscoring of the fact that there won't be detailed, in-depth instructions to guide the production of the CBC reports. I think the other big headline with respect to CBC reporting is the flurry of country activity around implementing such reporting. In the past year, 8 countries have begun or in a couple of cases completed the process of adopting the CBC reporting requirements, with the most recent being the UK, which proposed regulations on the same day as the final BEPS reports were issued. And I think as looking forward, the pace of activity, which accelerated significantly in the last few months, can be expected to further accelerate now that the final reports are issued. And as we watch what countries are doing, I think it's important to watch exactly what they enact. And in this regard, we're already seeing differences in the details of the country-by-country rules from country to country. So that's an important thing to watch, and it makes the central reporting mechanism, I think, all the more important.
So Barbara, not really any changes in the report vis-a-vis the previous report, but rather developing insight with practitioners on the actual complexity of country-by-country reporting, and really an accelerating uptake. I actually think that Norway was issued also on the 7th, but accelerating uptake by countries around the world with some deviations in requirements here and there. And we will, of course, address this in more detail in our webcast next Tuesday. Ronald, is that the same for master file? No big changes, and are countries sticking to the format? And do I understand correctly that Korea is implementing the master in local file, but doesn't necessarily seem to be implementing the country-by-country reporting at this moment?
Yeah, Alex, and to start with your question on Korea, that's correct. And this will have effects for the subsidiaries of Korean companies because of the secondary mechanism that Barbara just described. And to your earlier question, yeah, the same applies to master file and local file. No significant changes, no changes, I would even say. The final guidance is in line with the previous OECD documents. That said, I noticed that in discussions it often turns out that people don't realize that master file is not following the same distribution mechanism as country by country, like Barbara just described through the treaty mechanism by the parent jurisdiction. The master file should be prepared and can be requested in all countries where companies are doing business. Of course, that would only apply when these countries implement this in their domestic law. So it's not distribution through the head office country as for CBC. An interesting phenomenon in this respect is also the differences in association thresholds. So basically, with regard to master file, the question which companies form part of a group and which should be included in the master file. We will talk about that in more detail in Tuesday's webcast. If we look at what countries are doing, we closely monitor this implementation in domestic law. And until now, the proposed legislation for master file and local file in European countries is rather consistent with the OECD guidance. The OECD leaves open some topics for the individual countries, like the threshold for materiality, the penalties, and the language in which it should be provided. We see some slight differences, like for local file, the clarification in the Netherlands that the local file also applies to permanent establishment. But in general, I would say it is rather similar to the standard OECD guidance.
Thank you, Ronald. Andrew, China issued Circular 2 with draft rules for implementing Action 13. All countries participating in the BEPS discussions are supposed to conform to the framework for country by country. And if I listen to Barbara and Ronald, that's largely the case in the Western world. Is that also the case for China? And maybe also a brief look at other emerging markets? What other countries in your region are taking action?
Okay. Thanks, Alex. Well, the short answer to your question is yes. Because the Chinese State Administration of Taxation actually had a press conference last Saturday in Beijing that was attended by Rafael Russell, who is the head of the BEPS project in OECD. And during the press conference, the most senior international tax official at the conference actually delivered a very strong message that China will largely adopt the recommendation from BEPS. So if we look at the recently issued consultation draft that is going to revise Circular 2, I would say which is generally known as a TV menu in China, and the requirements on master file, local files, plus CBCR very much follow what Action 13 has suggested. So based on what has been suggested as the content to be included in the master file and local file, we can actually see the SAT has put additional emphasis on the disclosure of value driver of profits, contribution by group companies on value creation and value chain analysis. In terms of CBCR, the threshold is 5 billion RMB, which is quite close to the recommended threshold of 750 million euro of revenue, as stated in Action 13. In addition to what Action 13 has suggested and recommended, China is also planning to introduce an entirely new requirement, which is the special issues file, covering transactions like intra-group services, cost sharings, such new requirements is a continuation to the earlier efforts by the Chinese tax authority to scrutinize intergroup services through the benefits test. So while the SAT is still collecting comments, it is anticipating that the consultation draft will be issued in either end of this year or first quarter next year. So, but I would say it is unknown at this stage on which year the new documentation requirement start to apply. So outside China, in the Asia Pacific region, I think the most notable development is in Australia. Last month, the Australian Treasurer introduced a bill to implement the previously announced CBCR to the ATO with the application to income years commencing on or after January 1st, 2016. And given the amount of the penalty to be imposed for entering into any tax avoidance or like profit shifting scheme is double for significant global entities that do not have a reasonably arguable position. I think the importance of having a proper transfer pricing documentation going forward will be increased.
Yeah, that sure sounds so. Ronald, I really wanted to also continue with you about Action 8 to 10. What are the developments in this last report? I understand contracts are still basis for transactions.
Yeah, and I want to hook up to what Andrew just said about the services in China, which is also, there is a document in 8 to 10 on low value services, which is creating a safe harbor, and it seems like a very document for taxpayers. But I think there's a paradox there, and like Andrew said, the Chinese tax authorities will scrutinize intragroup services through the benefits test. But I think as a result of the publication of this document, it may also be that other tax authorities will start focusing more on the benefits test for services. And we already see that happening in practice somewhat. But then coming to, let's say, the question of 8 to 10 and the contracts as the basis for transactions, that is a very interesting discussion. There's some discussion actually in the OECD on the role of contracts and the role of legal ownership. And let me start with the latter. In the new guidance of Action 8 to 10, it's now clear that legal ownership is the starting point of the analysis. But it is also clear that the mere ownership is not enough to attract the residual profit or the intangible related profit. There's much emphasis in the new guidance on functions performed. So if the entity having the legal ownership doesn't perform the functions to assume the development risk, in case of development of an intangible, or to a lesser degree the financial risk, then its remuneration should not be more than a risk-free return according to the guidance. If the entity controls the financial risk, but not the development risk, then a financing return can be allocated. So to determine this, one has to actually establish who is controlling the important functions related to the asset. And that can be an intangible asset, and a lot of the focus of the OECD was on intangibles, but it also applies to tangible assets. There is a specific example on that in the guidance, and even can it apply to financial assets, and this is a consequence that is, I think, often overlooked here. So in the words of the OECD, this means that a cash box is not possible anymore. Well, a cash box, that's an entity without any functions, but with the legal ownership of an asset. And when I say that a cash box is not possible anymore, I of course don't mean that you cannot structure an entity like that, but at least in the view of the OECD, it attracts no more than a risk-free return. And I mentioned that there should be control of the important functions, and there should be control of the financial risk. This concept of control brings me, Alex, to your question on the role of contracts more generally. The contracts are still the starting point. At the same time, the guidance clarifies that when performing a transfer pricing analysis, the actual conduct of the parties is relevant. In other words, and like one of the BEPS country delegates indicated in an interview in the media recently, it is really about finding the real deal, the true deal. And this step is now called the actual delineation of the transaction. And the guidance provides a new 6-step framework, and this 6-step framework is different from what was in the previous guidance, in the revised discussion draft. The guidance wasn't that clear which steps to take in the analysis, but now it has been made more explicit in a framework. And an important element in this 6-step framework is that if a party does not control a risk, or it does not have the financial capacity to bear the risk, then the risk will be reallocated to another party. This is not considered to be a recharacterization by the OECD, but it's just, like I said, the actual delineation of the transaction. And only after the real deal or the actual delineated transaction has been established, then the transaction can be priced through a comparison with third-party transactions, for example, through a database study or looking at other type of comparables. So, in fact, arm's length pricing has now evolved in what I would call testing the arm's length behavior. So the comparability analysis now has 2 steps. First, finding the real deal, then pricing it. So a lot of words, Alex, to answer your question. Yes, contracts are still the basis, but the tax authorities will scrutinize them and will be able to base the pricing analysis on the actual conduct instead of on the based on the contract. Furthermore, like I said, new guidance was issued on low-value services, but there was also new guidance on commodities, and both of them are pretty much in line with previous discussion draft. And same goes for the part on the new guidance on intangibles that doesn't relate to ownership. That's basically about the definition of intangibles, a very broad definition, not completely linked to legal ownership, but more the question, is it something of value that a third party would be willing to pay for? So a rather vague and broad definition. There are no changes compared to the previous guidance that was issued, the draft guidance. There is new guidance on hard-to-value intangibles, effectively introducing a kind of commensurate with income standard, which allows the tax authorities to, based on information after the fact, to apply an adjustment to the price of an intangible, for example, to deem a price adjustment clause or to come up to other adjustments. And in the view of the OECD, this is all within the arm's length principle, within the arm's length standard, and should not be considered to be a special measure. And there's also important guidance on cost contribution arrangements, CCAs, with a similar stance as what I just said with regard to legal ownership, not relying on the mere funding, but requiring control as well. And what is also new, it's in principle not allowing a CCA anymore in which participants can compensate each other based on the costs of their contribution. There are exceptions to that, but now the general rule is that the CCA should be at value and not at cost. And I think that a lot of companies with a CCA or a similar arrangement might be affected by this.
So what's the timing of all of this?
Yeah, that's a very important point. In the guidance, the OECD has indicated that for those countries that formally subscribe to the transfer pricing guidelines, that the guidance in the report takes the form of amendments to the transfer pricing guidelines. And because of that, in many countries, for these new guidelines to be effective, no change in law or treaty is needed, because a lot of these countries have a direct reference to the transfer pricing guidelines, or their legal system is such that changes in the guidelines have direct effect. So we did a recent study where we surveyed several countries, both OECD countries and non-OECD countries, and it was clear that in most countries surveyed, the transfer pricing measures are expected to have an immediate effect, at least the changes in the transfer pricing guidelines. So immediate effect, that could imply even a kind of retroactive effect, because it could apply to any cases that are open at this moment. The TP documentation changes under Action 13, like the master file and the local file, in a lot of countries do require new legislation, and that is what you already alluded to Alex. That's what we see happening now, the countries introducing new legislation. So on the next slide, we have included a brief overview of the activity, and again, like I said, in most OECD countries, the guidelines are effective when adopted. In the non-OECD countries, only a limited number makes reference to the OECD guidelines.
So Thank you, Ronald. Andrew, again, how does China fit in that? It's not an OECD country. Does it refer to the OECD guidelines?
Correct. Well, China is yet to be OECD country, but actually, ever since the introduction of BEPS, China has become closer and closer with the with the OECD. July 1st this year, the Chinese Premier Li Keqiang actually visited the OECD in Paris. It was a historic visit because that represents the first time ever a visit by a very senior Chinese leader to the OECD. And during the visit, China signed the cooperation agreements with the OECD and joined the OECD Development Center. As a background, the Development Center is formed in OECD for knowledge sharing, policy dialogue, where developing countries, emerging economies, plus OECD members country could interact equally and directly. So this development has set the stage for China's commitment to adopt and follow guidelines and principles promulgated by OECD and not just BEPS. So in terms of implementation, the SAT has responded to Action 8 by introducing an entirely new chapters in the consultation draft to Circular 2 on intangibles. The concept therein, again, are largely following the recommendations and the corresponding languages in the final report of Action number 8. But then this chapter also includes some subtle differences that the Chinese tax authority want to introduce. Promotion is actually separately listed in addition to the normal DEMPI activities. Again, this demonstrates China's positions to emphasize the importance of the Chinese market in relation to IP creation. And there are also other newly introduced chapters in the consultation draft that recommendation under different BEPS action. But one point worth to mention, which is while China would adopt most of the relevant recommendations, also taken enough modification to those recommendations to reflect China's position on different kinds of cross-border tax disputes, namely like payment to limited substance affiliate or the use of the benefits test that was mentioned earlier to examine shareholder activities. So good knowledge of the relevant recommendation under BEPS would definitely help to understand the new legislation trend and developments in China, but additional attention would be required to understand any China modification and the related impacts.
Thank you, Andrew. Barbara, what do you see in the Americas around Action 8 to 10?
Thanks, Alex. The first comment I'd make is that the U.S. was very active in the OECD discussions around the changes to the transfer pricing guidance. Indeed, the U.S. was vocal in its concerns that some of the earlier drafts were not sufficiently aligned with the arm's length standard, and in their view would have gone too far in disregarding contracts. And I think looking at the final output, it does reflect some significant refinements in these areas. Representatives of U.S. Treasury have expressed their satisfaction with the end results with respect to transfer pricing, but at the same time, they have not indicated any immediate plans to make changes to the U.S. regulations on transfer pricing, which themselves similarly are an interpretation of the arm's length standard. In contrast to that comment with respect to the guidelines related to Actions 8 through 10, Treasury has made clear that they intend to issue regulations and a form for country-by-country reporting. Their plan is to put it out in draft form for comments before the end of this year. They have, I think, repeatedly expressed their commitment to going forward with this, and acknowledge the expectation of other countries that the U.S. will do this. There's been some debate in the U.S. about whether country-by-country reporting can be implemented by administrative action, or whether it would require legislative change. On that point, Treasury has been clear in its view that they have authority. They have the authority they need in order to be able to put this into regulations.
So very clear statements, continued clear statements that CBCR will in fact be implemented in the United States. Ronald, can I ask you for some comments to conclude on the Action 8 to 10 piece, and also how Europe is looking at implementing this?
Yeah, and it's not only 8 to 10, Alex. I will come to that. It's also on CBC within Europe, even discussing public CBC, but I'll come to that in a minute. Actually, within the European Union, quite a lot is going on at this moment. There is, and that's important to make a distinction between the various bodies of the European Union. There's activity from the European Parliament and a special committee on tax called the Tax E Committee. There are very far-reaching proposals from Parliament and the Tax E Committee, both on tax policy-related matters, but also, like I said, on transparency of country-by-country reporting and of tax rulings. Furthermore, the European Commission is proposing some actions, and then finally the European Council has taken initiatives. And like I said, it's good to put these roles a bit into perspective, because in the end, for all proposals to become hard law, the consent of the European Council, so the ministers of the member countries, is needed. The other bodies, like the Parliament and like the Commission, they can make proposals, but in the end, they need this approval. That said, the European Commission launched an action plan on June 17 of this year, an action plan for fair and efficient corporate taxation in the European Union. One of the key actions there is the relaunch of the so-called triple CTB, the CCCTB, the Common Consolidated Corporate Tax Base, let's say formulary apportionment within the EU. And the efforts to introduce a CCCTB have not been successful in the past. But as a first step, the Commission now suggests to analyze the introduction of a double CTB, a CCTB, which would not be consolidated. So more harmonization of the tax base and not the formulary apportionment right away. Furthermore, the Commission is proposing a measure to close legislative loopholes, and they also see that the CCTB would help in countering and closing legislative loopholes. They also propose to improve the transfer pricing system, and they target for the implementation of stricter rules for preferential tax regimes. And like I said, at this moment they are consulting on the feasibility and desirability of public country-by-country reporting to be included in the financial statements of companies. With respect to transfer pricing in particular, the EU is not, in the action plan, not completely clear on what this means, but there is a body of the EU, the EU Joint Transfer Pricing Forum, that deals with transfer pricing matters. This forum has recently published its program of work for this, and it seems to be based on this action plan of June 17, or implementing this action plan with regard to transfer pricing. Some of the key items of the work program are focused on taxpayers' IT systems and the interaction with transfer pricing, a very interesting area of work. It is also focusing on the use of comparables specifically within the EU. So the question whether the EU is one market or not, whether you could use regional comparables or not. They also look at the use of profit split, again, specifically within the EU. And that's important to mention, because they say as a starting point that they will stay within the boundaries of what the OECD has published and will publish. And finally, on the use of economic valuation techniques. So I would say quite some practical issues that are of importance for our clients. And then there are some more tax administration related topics. including the focus on multilateral audits, and we have seen increasing activity on the audit field and multilateral audits in Europe already in the past years.
Ronald, thanks for that. Interesting developments in Europe. So let's move to the next batch of action items, the ones that need further legislative action in the countries or some type of treaty-based action. Let's start with the latter group and look at what the future holds for Action 14 and 15 and Action 6. And maybe, Barbara, you can take us through 14, 15, and 6. And do I understand that the United States will now become part of the Action 15 discussions?
Great, thanks, Alex. So, and I think in focusing on the treaty-based recommendations, the best place to start is Action 15 and the multilateral instrument. The report on Action 15 is itself fairly unremarkable. It's basically a reproduction of the 2014 report that addressed both the legality of a multilateral instrument as a mechanism for accomplishing the simultaneous amendment of a whole network of bilateral tax treaties, and also the desirability of such a tool. And the 2014 report concluded that it was both legal and desirable. So I think what is more remarkable maybe is what the OECD has planned with respect to Action 15. They have indicated that at this point they now have 90 countries who have signed up to participate in the negotiations with respect to the multilateral instrument, and that does include the United States. The U.S. has stressed that they have a particular interest in advancing the discussions on arbitration as a dispute resolution tool, and so that was a reason to participate in this Action 15 discussion. The group is organized with a leadership team that I think reflects the real diversity of this project now that it is for the OECD, the G20, and beyond. So the chair of the negotiating group is the delegate from the UK, and the vice chairs are participants from China, Morocco, and the Philippines. They have had an organizational meeting back in the spring of the group, but the first substantive roll-up-your-sleeves kind of meeting is scheduled for the end of the first week of November, so coming up quite quickly. And as they start in November of 2015, their aim is to be done with the negotiation and have the instrument ready for signature by the end of 2016. The focus of their work is on the treaty-based recommendations. So in earlier discussions regarding this instrument, it was suggested that perhaps it could be adapted to be used for addressing some of the domestic law recommendations. But at least at this stage, they are focused exclusively on the treaty-based measures that are included in the OECD's output. And the concept is that in this negotiation they will take the recommendations from those other actions as they were completed, and won't modify them. Their work is to find the mechanism for taking that substance and applying it to this network of bilateral treaties. I think it will be interesting to see how that plays out. It's, I think, an important note that participation in the negotiating group is not a commitment to sign up to the instrument, so there's a second decision point after they complete the instrument. That said, it does seem that there are quite a few countries that are eager participants and see this as an efficient mechanism to advance some of the recommendations that were particularly important to them. So I think the bottom line is that with this instrument, we could see a substantial acceleration of the treaty-based recommendations, where one might have thought that those would take could be the slowest to be brought into force because of the many steps involved. This multilateral instrument is intended to cut through that. So thinking about what will the group be focused on, I think most essential will be the work on Action 14 and dispute resolution. We'll talk a little bit more about the specifics of the action, but the recommendations take the form of minimum standards. So commitments that the countries have made to improve access and use of the MAP process, and then best practices for accomplishing those minimum standards. Now, many of the best practices here will be memorialized in forms other than changes in the MAP article itself. But there are some changes to the treaty text, and that's the focus for the interaction between this action and the multilateral instrument. The OECD also, with respect to Action 14, has indicated that they are planning to develop a process for monitoring developments and monitoring the behavior and success of the participants in the MAP process. And they will do that through a peer review process. I think in some ways this aspect of the future monitoring may be quite different than the overall monitoring that they're doing with respect to BEPS because of this intended use of a peer review approach, which has been used by the OECD in the past for other administrative type areas. I think all of that about Action 14 is sort of ignoring the elephant in the room. The biggest element of Action 14 is the question about whether we use arbitration as a tool to prevent and resolve disputes. And there clearly was huge disappointment that there wasn't an overall consensus on arbitration. And that was disappointment by the business community, but also disappointment by many of the countries that are participating, and see arbitration as an essential tool. I
was interested to see Canada and certainly the U.S. in the list of countries, both for 15 and 14, which would be terrific news for many listeners, I no doubt. But how likely do you actually think it is to get that through the U.S. treaty process?
Well, I think the U.S. is a vocal advocate of mandatory binding arbitration. They're one of the leaders of this group of 20 countries that form this coalition of the willing and have made a commitment to put arbitration in place. The U.S. focuses on arbitration in the form of baseball-style arbitration. They view it as essential to getting the competent authorities to the table, and the U.S. has had real success with the arbitration rules that are in place currently, including the rules with Canada, which have seen real improvement in that competent authority relationship. So I would definitely say that we will see more arbitration provisions in U.S. treaties in the future, and the Senate that has the advice and consent role with respect to treaties also has weighed in and on arbitration and has approved treaties with arbitration clauses in several instances. All of the recent treaties that have been brought in the last several years. So I guess the question here really is more. Is not a substantive one with respect to arbitration, but really just one related to the timing of moving treaties forward, given the procedural hurdles that exist in the Senate process right now. So maybe Alex, with that, should we turn to Action 6 on preventing treaty abuse? So as mentioned, that one is considered a minimum standard. While it's a minimum standard, there is a significant amount of optionality around the recommendations, and really, I think we see that most specifically with respect to the centerpiece of the work on Action 6, which relates to rules to address treaty shopping. And there, we've got the U.S. Tradition of using limitation on benefits provisions, so detailed and objective mechanical rules to address treaty shopping. While in other countries the tradition is to use something like what the OECD has proposed as a principal purpose test, which is a more subjective or qualitative, less mechanical test that functions like a general anti-abuse rule. The OECD originally proposed or recommended that countries should include both in their treaties, but through lots of discussion throughout the OECD process, when they put out the interim report on Action 6 last September, they had moved to an approach that gave countries options. Do the gold standard in the OECD's eyes and include both a limitation on a benefits rule and a principal purpose test, or do one or the other. And that allows the U.S. to go forward with its traditions of insisting on limitation on benefits provisions without requiring that other countries that have less experience or less interest in limitation on benefits provisions use them. I think it will be interesting to see how that optionality gets handled in the multilateral instrument. I think a bit of a drafting challenge, perhaps, so that the pairs of countries that participate in the multilateral instrument can get to the result that they're looking for. I think just one other note with respect to Action 6. There is some significant additional work that the OECD has committed to relating to how to apply these limitations on treaty benefits to investment vehicles. They had done for several years significant work with respect to collective investment vehicles, and that work has been married up with the work on Action 6. But they've indicated that going forward, they need to address the same issues with respect to investment entities of different forms. So that will be very important to watch going forward.
Thank you, Barbara. So Ronald, 14, 15, 6, but I think the other one that is treaty-based is Action 7. Where are we now? What can we expect? And especially, is there anything we can expect already with respect to the profit attribution to PEs?
Yeah, I will talk about that. But Alex, I see a question coming in on baseball arbitration, and not being a U.S. expert, always dangerous to answer it, but Barbara can chip in. I think the difference between traditional arbitration and baseball arbitration is that in baseball arbitration, the two countries involved can take, let's say, one position, and then the arbiter has to choose that position. So it's not, let's say, the original adjustment, and then there could be a kind of negotiations during the arbitration phase, but they both have to take what they think is a reasonable position, and then the arbiter has to choose, has to pick either of these. If I'm phrasing that correctly, but Barbara, happy if you jump in.
Yes, I think you've got it right on baseball arbitration, and it's viewed, I think, by many countries as an important mechanism that balances some of the concerns about government authority, that they're not ceding to the arbiter an ability to develop its own adjustment, but just choose between the positions of the two governments.
Yeah. So that question being answered, let's move on indeed to Action 7. The final guidance on Action 7 addresses similar topics as were addressed in the previous discussion drafts, so foreign sales structures, the change in the definition of the exceptions for preparatory and auxiliary services or activities, and splitting up of contracts. And as expected, no specific rules for selling insurance are included anymore. They were in the first draft, not in the revised draft anymore. And as was announced before, a very important question is how much profit should be allocated to a PE when there is a PE. The OECD decided to perform follow-up work on this question, and this necessary guidance will be provided before the end of 2016 so that it can be included in the multilateral instrument that Barbara was alluding to. And although the topics are similar to the discussion draft, to the revised discussion draft, there are some important changes in the Action 7 document, specifically with regard to sales structures. And this is important because these new rules may affect many multinational businesses. In the draft guidance, a permanent establishment would be created if a person on behalf of an enterprise in another state would habitually negotiate material elements of a contract, even without concluding the contract. In the final guidance, the threshold has been increased, and so the final guidance is somewhere between the current rules and the previous draft. It now determines that if a person habitually plays the principal role, leading to the routine conclusion of contracts without material modification by the enterprise, this would lead to an agent PE. So this typically would relate to cases where the conclusion of contracts is clearly the result of these activities, although the contract has formally been concluded outside that state. So it is about the person who convinces the client to enter into the contract. And the guidance therefore applies to where, for example, a person solicits and receives but does not formally finalize orders which are sent directly to a warehouse from which the goods belonging to the enterprise are delivered, and where the enterprise routinely approves these transactions. It does not, and that the guidance is clear on that, it does not apply where a person merely promotes and markets goods or services of an enterprise in a way that does not directly result in the conclusion of contracts. And typical examples that would fall under the new guidance would be agents and commissionaires. The guidance mentions an example in which the person's remuneration is partly based on revenues, and apparently this is an important factor to the OECD to decide whether you play a principal role. It's also clear that a so-called limited risk distributor is not acting on behalf of the principal, and as such would not constitute a PE. Because so if you're in the invoice chain, it would not constitute a PE. If not, the agent, it could become a PE. As said before, future guidance will be developed on profit allocation. The document now already mentions that it's important to note that this does not mean that the entire profits resulting from the performance of these contracts should be attributed to the permanent establishment. The separate entity approach will have to be applied. So it seems that the OECD will not deviate here from the existing approach for profit attribution, the AOA, the authorized OECD approach, as is included in the current Article 7, which is good news. And compared to the revised discussion draft, there are no changes with respect to the anti-fragmentation rule. And because this may affect many multinational businesses, it may be good to elaborate a little bit on that anti-fragmentation. And under this rule, activities of two different legal entities will be jointly considered, provided that they fall under the group definition when you're closely related. And if the activities of one of those entities on a standalone basis would be exempt, would not be a PE, because they would fall under the exception for preparatory activities, it could now, under the new guidance, still be a PE if analyzed jointly together with the activities of a group entity in that state. And if the joint activities would not be considered preparatory, then the first mentioned activities could be a PE. And one of the examples given here in the reflects a warehouse of a principal company in another state. And from this warehouse, goods are delivered to a related distributor in that same country as where the warehouse is. And the warehouse of the principal company could now constitute a PE, whereas in the current rules it would fall under the exemption. And of course, it remains to be seen how much profit should be attributed to such PE. This could be little profit, but even if this would be limited, it might still create compliance issues, and it may trigger other tax discussions like wage tax and VAT. So, and I will pause here, Alex. There's a lot more to be said about this, and it will impact many of our clients, but given the time, I hand back to you.
Thank you very much. I think that warehousing, anybody that currently has an Article 5.4 exemption should at least have a look at what they're doing and how these rules may apply in the future. So, Andrew, what is the conversation in the emerging markets around these OECD model treaty-driven changes? 90 countries have now committed to participate in the model treaty, in the new multilateral treaty. China, India participating in this. What will be their focus area in these discussions?
Well, unlike other actions that we cover, like Action 8 to 10, where China has already reacted to the relevant recommendation. But speaking for Action 6 or 7, for the time being, there's no specific action has been taken as of today, and there's no timetable as to when the related interpretation will be revised. And for the record, the local legislation governing or providing the Chinese interpretation of the conventional treaty model is a circular 75. That circular covers the interpretation of the China-Singapore Treaty, but all the related interpretation will be equally applicable to other Sino-foreign treaty. But even though there's no specific timetable or timeline, but in terms of focuses, during the press conference last Saturday, the Chinese Tax Authority expressed their key interest on the proposed revision of Article 5, this is paragraph 4 and 5, covering the preparatory and auxiliary activities, and also the definition of dependent agent in the conventional treaty model. So they indicate they will definitely keep track of the development, and if there's any development, very likely they will put through the changes as a supplement or revision to the existing Circular 75, which, as I mentioned earlier, providing the China position and interpretation of the conventional treaty articles.
Thank you. So again, focus on PEs, and maybe a good time to plug the permanent establishment webcast that we have, where we will dig into this much further on November 5th. So let's move to our last group of action items, the ones that need legislative action. In anticipation of BEPS, quite a few countries have already been rulemaking very actively. Barbara, Action 2 on hybrids seems to be a bit of a hybrid itself, part depending on future treaty language, and but mostly proposals for local country law. Perhaps a good way to transition from OECD treaty-related action to local jurisdictional action. Can you take that away and address that, and also what countries are expected to do with Action 4?
Sure. Thanks, Alex. So Action 2 on hybrids was a 2014 action, which meant we saw the first report in September of last year. That report set out a complex framework for addressing hybrids and identified several areas where the OECD was continuing to do technical work. The final report follows last year's report and provides the results of that additional technical work, but it also does a good bit more. The Action 2 report includes several hundred pages focusing on providing implementation guidance and also including numerous illustrative examples. So a lot of reading in the Action 2 report. And while it includes a handful of treaty-based measures, Action 2 is mainly focused on domestic law solutions. So it is a complex construct of rules to deal with situations where you have a deduction on one side and no inclusion on the other side, or a situation involving double deductions. And the approach is a set of primary rules and then a secondary or defensive rule that can be applied where the primary country doesn't take action with respect to the hybrid. So generally, the rules apply to a variety of types of instruments. The general approach is to favor denial as the applicable measure with required inclusion of income generally the defensive measure. Many countries have already enacted rules around hybrids. I think it is hard to imagine a country taking up the entire construct that's reflected in this Action 2 report wholesale. But countries will pick and choose among the elements, and in fact have already begun to do that. Turning to the final report on Action 4 on limiting interest deductions, this one's quite interesting as it was significantly scaled back from the discussion draft of earlier in the year, and also some other proposals that have been made by country delegates during the dialogue within the OECD. So the key elements of the proposed limitation include an optional de minimis rule that countries could include. The base rule is a rule that would limit net interest expense to a fixed percentage of EBITDA. The OECD recommends something in the range of 10 to 30%, provides some principles and considerations for countries to take into account as they set their number. It also includes a group-wide test that looks to the comparison of the particular entity's leverage as compared to the group as a whole. In the discussion draft, that was a rule of at an equal level to the fixed ratio rule as an alternative or a side-by-side rule. And this report has it serving a role as a safe harbor type rule, something to look to if your interest is not fully allowed under the fixed ratio rule, then look to this group rule. The OECD indicates that they need to do some more technical work on the form of the group rule. And they've also indicated that they intend to do additional work on how these rules should apply to regulated financial services businesses, where interest plays a very different role in that business than it does for other taxpayers.
Okay, so looking at that then, Andrew, what do you expect the take-up of Asia-Pac countries to be on 2 and 4?
Well, speaking of Action 2, there has not been much directly relevant development about country in Asia-Pacific, like including China. Well, probably due to the fact that hybrid instrument has never been very prevalent in the Asian context, if we have to compare with the U.S. and the Europe. But still, there's some development, but the development wasn't really recent. Like, if we look at Singapore, Australia, they separately issue legislation last year. For Australia, they enacted a new legislation that denied exemption for foreign non-portfolio dividends on instruments that are debt for purposes of Australian debt equity rules. Notwithstanding to their legal form. So these impact instruments such as mandatory redeemable preference shares. So this is what Australia had done last year. Singapore has done something similar as well. They issued a circular last year on tax treatment of hybrid instrument to clarify what it would look at the legal rights and obligation created by the instrument, but not just the legal form. New Zealand has voiced out the attention that will be paid on Action 2 as well. For Action 4, I would say the most recent and noticeable responses in the APAC region is in Japan, because the Japanese government is considering further reducing deduction for interest paid by corporations to related person under the earnings stripping rules. So under the current rules, the net interest paid to related person by a corporation in excess of 50% of its adjusted taxable income is disallowed as tax deduction, and the disallowed interest deduction are carried forward for up to 7 years. And right now, the government is reporting is considering lowering the threshold to 30% instead. So the bill proposing such changes is expected to be submitted to the ordinary sessions of the Diet in 2017. So this is more or less covering Action 2 and 4 in the APEC region.
Thank you very much for that. And moving westwards, Ronald, we've seen quite a bit of action around Action 2 in Europe. Netherlands just issued draft regulations. Perhaps a quick minute on what's happening there?
Yeah, Alex, the EU has introduced in the start of 2015 an amendment to the Parent Subsidiary Directive, so hard law that countries have to implement in their domestic law. It is meant to prevent international mismatches, an anti-hybrid rule. It basically says that if a payment on a financial instrument is deductible in the payer country, then the receiving country should not exempt the receipt. So, for example, not apply a participation exemption. So a linking rule. It has similar effects as Action 2 of the BEPS Action Plan, although Action 2 is broader and is also related to hybrid entities. Furthermore, the directive also contains a general anti-abuse rule, a bit like the principal purpose test in BEPS Action 2, and the member states have to implement the EU directive as said, and the proposal that you've seen in the Netherlands is an example of that, Alex.
Thanks, Ronald. Barbara, I think a lot of listeners, especially on the inbound side, will be interested to understand what we think the United States is going to do with Action 2. Do you think the U.S. will also adopt a fixed ratio rule, and what do you think, what percentage it will use?
Well, during the development of the OECD recommendations on Action 4, the U.S. was one of the most vocal advocates for very strict limits on interest deductions, and in fact called for denying deductions for interest in excess of 10% of EBITDA, so the low end of the range the OECD ended up with. And Treasury has expressed some disappointment that the OECD recommendations on Action 4 didn't go as far as they would like, and I think that's sort of consistent with their proposals for legislation domestically in the administration's budget. They have included a proposal for interest limitations for inbound investors that would tighten up those rules dramatically and would have a net interest limit based on 10% of earnings applicable to U.S. subs of foreign parent companies. So really a proposal for what would in effect be a super 163J limitation. The issue of interest limitation is a focus area in the broader discussions on international tax reform, and the discussions in Congress contemplate that there would be some limitations built into any fundamental changes in our international tax rules. From the Senate side, there's been sort of careful comments that in their view any limitations should apply equally in both directions. So for both inbound and outbound should be under comparable rules. And the most specific proposal that's out there pending before Congress would change the limitation to effectively a 40% of EBITDA rule and apply it in both the inbound and outbound contexts.
Thank you. Ronald, perhaps address what's, moving to the next action item, what's happening around Action 5, since this seems most focused on European patent boxes for now. And also it seems related to the increased transparency about ruling exchanges, etc.
Yeah, Alex, it's a bit misleading because Action 5 is indeed looking at patent boxes, which in practice now means European patent boxes, although other countries like the US are considering the introduction as well. But the topic of Action 4 is more of a general nature. It describes how to determine whether preferential tax regimes are considered harmful. And as a kind of pilot project, the OECD looked at patent boxes. It builds on earlier work of the OECD's Forum on Harmful Tax Practices. And next to existing criteria that forum already applied, like transparency, ring fencing, and low and no tax, the substantial activity criterion was elevated to a higher level. And now this is one of the key criteria. And for patent boxes, it basically means that there should now be nexus between the income from the intangibles that qualify for the patent box and the activity in the country. And as a result, R&D work can only be outsourced to group entities to a limited extent under the new rules. And to test whether there is substance, the OECD developed a so-called modified nexus approach. Essentially, this means that the expenses in a certain country expressed in the total development expenses are a proxy, this ratio is a proxy for testing which part of the substance is in that country and which part is outside that country. And this mechanism will be applied to patent boxes, and most likely, I think the EU will adopt this approach in their evaluation of patent boxes as well. But in the future, it will also be applied to other preferential regimes the OECD has stated, like headquarter regimes, distribution or services centers, finance or leasing regimes, shipping and holding companies as well. But that's future work for the OECD. Coming back to patent boxes, countries will have to change their domestic law. This is a minimum standard action item as well. There's a grandfathering period for taxpayers already making use of a patent box regime as per 30 June 2016. And the grandfathering of the application for existing IP until 30 June 2021. European countries will change their law because they have committed themselves and because the EU, through the Code of Conduct Group, will force them to do so. And based on the new substantial activity requirement, a number of preferential regimes in the OECD and in associated countries were reviewed by the OECD. The result of that is included in the report as well. If I'm not mistaken, around 43 regimes have been reviewed. In more general terms, also the OECD looked at informal capital regimes and exit profit regimes, like applied in, for example, Belgium. And the conclusion here is that for such regimes, the lack of transparency was the main issue, and not the regime as such. And since rulings will be exchanged, no further work on these regimes is needed as for now.
Thank you, Ronald. And Barbara, where do we stand in the Americas on Action 5? I understand that there's a proposal for an IP box in the U.S.
Indeed, there was. There has been, Alex. Congressman Bustani and Neal in the Ways and Means Committee in the U.S. House introduced a proposal for a U.S. innovation box, so broader in application beyond patents to other forms of IP. And the idea is to include a version of such an innovation box in an overall international tax reform package. I think the view expressed by many lawmakers in Congress is that the BEPS project and the new nexus and substance requirements in particular could have the effect of driving U.S.-based companies to move more activity outside the U.S. together with the associated jobs. And so in thinking about international tax reform and the competitive pressures, the idea is to counter this with rules that will make the U.S. a place to maintain that innovation activity.
Thank you. I may have forgotten, Ronald. Let's get back to that. The exchange of rulings in Europe, and actually how that actually moves into the Action 5. Can you get back to that?
Indeed. Well, I think it was the mentioning of the innovation box in the U.S. is very important as well. But I think the exchange of rulings. It seems at first start that would only be for preferential regimes in particular, but now the scope of the exchange is much broader, Alex, including unilateral APAs and PE rulings, and furthermore, and that's important, it has retroactive effect. And the day after the OECD published the report, the EU Finance Ministers' Council adopted a similar measure on transparency, also with retroactive effect, even 5 years back, although the scope is somewhat narrower. And I think that the scope of the OECD deliverable on this was quite unexpected. And I do see in practice that this gets a lot of attention. It is also a minimum standard, as I said, so countries have apparently agreed to implement this, Alex.
Thank you. And because we're nearing the end of our webcast, Barbara, a very quick highlight of some of the action items that we didn't address?
Sure, Alex. I think just as you say, just a few quick points, because the output on of these actions is quite different than what we've been discussing. So, Action 1 on the tax challenges of the digital economy really overarches the whole action plan. Final report here closely follows the September 2014 report. Bottom line. Conclusion is that the digital economy issues are going to be addressed through the other actions, reflecting a recognition that it wouldn't be sensible to try to write special rules for the digital economy, as all things digital permeate all aspects of the economy. The output on Action 3 on CFC rules is in the form of best practices for countries to consider if they are interested in implementing a CFC regime or modifying their existing rules. I think important here to note is that in contrast to the discussion draft, the final report really strongly emphasizes the different policy objectives around CFC regimes and the different prioritization that of these objectives when you look country to country. So the report here stresses that this is not in any way a minimum standard, but practices for countries to consider. A similar result for the output on Action 12 on mandatory disclosure of aggressive tax planning. This report also is in the form of best practices for countries to consider, and the report stresses the need for countries to tailor any rules of this type so that they mesh seamlessly with the other aspects of their own reporting and compliance systems.
Thank you very much, and thank you to all the panel members, especially Andrew at a very late hour. So in closing, the working groups and the project teams at the OECD have certainly produced a significant amount of content, a lot to consider, and we will be further considering this in our future webcasts. And if I look back at the results of the BEPS initiatives the last 2 years, I would like to put forward that the intent of the OECD for the BEPS initiative is to change the way multinational companies are conducting their business. And it is likely that the businesses of many of our listeners will be impacted by these changes. We have divided today's discussions into 3 buckets. In the first category, we have country-by-country reporting, master file and local file, and Action 8.10 on intangibles, risk and capital and high-value transactions. Enterprises really cannot wait any longer and must consider how these action items apply to their organization. Understanding, for instance, how the terms of art in the CBC implementation package are translated to their business, and what the new definitions on IP and ownership of IP mean for their companies. In the second category, reports that need implementation by the OECD in the OECD Model Treaty or in the new Multi-Country Tax Treaty, there are the treaty abuse provisions, the new permanent establishment rules, and of course, and hopefully arbitration and mutual agreement procedures. These provisions will take a while longer to be effective, but can significantly impact your operating model. And since their outline, due to the work to date done by the OECD, is already quite clear, it does make sense for enterprises to review the extent to which they would be affected by these changes. And then finally, in the final category, hybrids, financing, CFC, harmful tax competition. These are quite tricky to give a time frame to. However, many countries have already engaged in legislative action, and many countries still will. So the implementation date is more fluid, and enterprises need to stay up to speed on what happens in the jurisdictions where they have footprint. Overall, I have no doubt, though, that these October 5 reports from the OECD will have wide-reaching implications for governments and companies as policymakers consider changing the framework for taxing cross-border business activity. We can expect to see changes in tax policy, tax legislation across numerous countries based on the substantial work that has been done by the OECD and the G20 over the past 2 years. And as countries adopt different approaches, there is much work ahead and continued input from the global business community and all other stakeholders continue to be needed. So I'd like to thank panelists again for sharing their views and their experience with respect to the latest BEPS developments. With all of you and me on this webcast today, I also want to thank our audience. I know that for some of you this has been very early or very late, and I want to thank you for your attention and your questions. Please don't forget to register and tune into the webcast that we have organized for you in the coming weeks on the various action items. If you've been with us for the full 90 minutes, responded to the polling questions, and completed the feedback, you can now download your education certificate by clicking on the purple CPE icon at the bottom of this interface. Now, before you sign off, please take a moment to open the red feedback icon and let us know what you thought of today's program. And as always, we hope that you'll join us for the future webcasts. From the Thought Center, I'm Alex Postma, and we've been bringing you insights into the latest developments in the OECD BEPS projects from EY.
Thank you for participating in today's webcast. You may now disconnect.